All right, guys, welcome back. So a little while ago, I sat down and walked you through three stocks that Wall Street absolutely hated: Intuit, Salesforce, and ServiceNow. The story was ugly. AI was supposedly going to eat all three of them alive. The stocks were getting crushed. And I said, when everybody hates something, that's usually a good time for a smart investor to start paying attention. Well, I'm back because a lot has changed, and I want to be completely straight with you. Some of it changed in ways that make these businesses look better than I thought. Some of it raised new questions I didn't have before. And one of them just had a quarter so strong that the CEO basically said on the earnings call, "We underestimated ourselves." So we're going to go through all three again. Updated numbers, updated story, updated take. Same honest format as always. We look at the business, we look at the numbers, and we actually think about what they mean instead of just reacting to a headline. Let's get into it. So let's start with Intuit. You know them as TurboTax and QuickBooks. And the last time I talked about this stock, it was sitting around 405, down about 50% from its all-time high of $814. The fear was simple. AI is going to kill TurboTax, AI is going to kill QuickBooks, and on top of that, MailChimp was already bleeding customers. All of that was real. I'm not going to pretend it wasn't. Here's what happened since. The stock actually went lower. It touched around $361, a 4-year technical low. So if you've been holding this one, that has not been a fun ride. But here's what I need you to focus on. The business did not fall apart. Q1 of their fiscal 2026, total revenue up 18% year over year. Q2, revenue up another 17%, coming in at $4.7 billion for the quarter. Operating income up 44% in that same quarter. Earnings per share up 49%. Guys, those are not the numbers of a company whose core product is getting eaten alive by AI. Those are strong numbers, really strong. Now let's talk about the AI fear specifically, because that was the whole thesis for the sell-off. There were two main worries. One, that tools like ChatGPT or Perplexity would replace TurboTax. Two, that QuickBooks would get disrupted by cheaper AI native alternatives that could just do everything from scratch. Here's the update. TurboTax revenue grew 12% in the most recent quarter. Not dead, still growing. And here's the thing that actually impressed me. Instead of fighting AI, Intuit leaned into it. They built what they call a done-for-you AI experience right inside their products. And as of Q1 fiscal 2026, 2.8 million customers are already using AI agents built directly into QuickBooks. 2.8 million. That is not a pilot program. That is adoption. And I'll tell you something personal here. Last time I told you guys I was downloading QuickBooks reports, emailing them to myself, and dropping them into Claude to double-check the numbers. My own workaround. Well, Intuit's answer to people like me is, we're building that inside the product. So instead of you doing a workaround, the system catches the issue in real time as you're entering data. If they execute on that, the switching cost gets even higher than it already was. Now I'm not going to pretend everything is perfect here. MailChimp, which they paid $12 billion for back in 2021, is still a drag on the overall numbers. But when you strip MailChimp out, their core business grew online ecosystem revenue 25% and their global business solutions segment 21%. That tells you the accounting and tax business is doing really well. It's the email marketing acquisition that's pulling the average down. Full year guidance for fiscal 2026 is revenue between $21 and $21.2 billion, double-digit growth. They raised their dividend 15%, and some major analysts, North Coast specifically, upgraded the stock to buy after the pullback. So let me put some numbers up here. Stock price right now, roughly $361 to $380. All-time high was $814. Free cash flow last year, $6.84 billion. Price to free cash flow, around 16 to 18 times, which is historically very low for this company. Revenue growth the last 2 quarters, 17 to 18%, and the forward PE around 23 times, down from historical averages of 40 to 50 times. Think about that. The market used to pay 45, 50 times earnings for Intuit because it was considered this wide moat, untouchable software company. Now it's 23 times. What changed? The fear changed. The actual business? Still growing double digits. Still generating nearly $7 billion in free cash flow. Still owns something like 85% of the small business accounting market. Does AI represent a real threat going forward? Yes, I think it does. But right now, the numbers are telling you that AI is acting more like a catalyst than a killer. That can change. I'm not going to pretend it can't. but you have to price a stock based on what is actually happening, not just on what might happen. My take on Intuit is this. The AI narrative got way out ahead of the reality. The last time I covered this, I had puts on it. I was trying to buy it lower and getting paid to wait. The business outperformed what I was afraid it might do. If you run the analysis today with conservative assumptions, 8 to 10% revenue growth going forward, free cash flow margins around 28 to 30%, a modest multiple, you still land in a range that makes this stock worth serious attention at these prices. The fear was real. The business held up anyway. All right, stock number 2, Salesforce, ticker CRM. And I'm going to say this up front. This one is the biggest surprise of the three. Last time I talked about Salesforce, the concern was that AI agents were going to replace Salesforce seats. Why would a company keep paying for this massive CRM platform when an AI can just handle the whole thing directly? That fear was driving the stock down hard. Here's the plot twist. Salesforce didn't get replaced by AI. Salesforce became an AI company. They built a product called Agentforce. It's their AI agent platform. And listen to what just happened. In fiscal year 2026, which ended January 31st of this year, Salesforce closed over 29,000 Agentforce deals. That's a 50% increase just quarter over quarter. Their Agentforce annual recurring revenue hit $800 million, up 169% year over year. And combined with their data cloud product, total AI-related annual recurring revenue crossed $2.9 billion. Guys, they went from AI is going to destroy us to we are the AI operating system for the enterprise. And the numbers back it up. This is not a marketing slide. These are signed contracts, closed deals, real revenue. And look at the broader financials. Full fiscal year 2026. Total revenue $41.5 billion, up 10% for the year. The final quarter alone was $11.2 billion, up 12% year over year. Fastest quarterly growth pace since early 2023. Non-GAAP operating margin hit 34.1%. Earnings per share beat estimates by 25%. And their total remaining performance obligation, essentially their contracted future revenue backlog, exceeded $72 billion. $72 billion locked in. Oh, and one more thing. They just authorized a $50 billion share repurchase program. That's roughly 26% of their entire market cap being used to buy back stock. That is management saying, as loudly as they can without literally saying it, we think this stock is cheap. So why is the stock still down? Fair question. Because even with all of this, the stock is still well below where it was. And the market's frustration is actually pretty straightforward. Their guidance for fiscal 2027 came in at around 10 to 11% revenue growth. Decent, right? But Wall Street wanted more. They wanted to see Agentforce blow up the top-line growth number immediately, not just the ARR line. And that's a legitimate debate. Is $800 million in Agentforce ARR going to become $5 billion fast enough to justify a higher multiple? That's genuinely the question. Here's how I think about it, though. They've got $72 billion in remaining performance obligations. They've got a 34% operating margin. They're buying back 26% of the company. Nearly 95% of their revenue is subscription-based. That means it's recurring, it's predictable, it's not going anywhere. And their AI product is the fastest growing line in company history. The market is pricing this like a company in slow decline. The financials are telling you the opposite. Let me put the numbers on screen. Stock price right now, around $182 to $185. Market cap roughly $176 billion. Fiscal year 2026 free cash flow, approximately $15 billion. Price to free cash flow, around 12 times. Guys, 12 times free cash flow for a business doing $41 billion in revenue, growing at double digits with a $72 billion pipeline. I run this with my own conservative assumptions. 7 to 10% revenue growth over the next decade, well below what analysts think. Free cash flow margins expanding to 30 to 35% over time. A reasonable long-term earnings multiple in the 18 to 22 range. Even in the low scenario, you get a return profile that's hard to completely walk away from at $182. My take on Salesforce, of the three stocks we're going through today, this one has had the most dramatic story change in the company's favor. The original fear was AI replaces CRM. What actually happened? Salesforce is leading enterprise AI adoption and charging their customers for it. Whether the stock catches up to that reality is a timing question. Whether the business is better than people thought, to me, that's pretty clear. All right, stock number 3, ServiceNow, ticker NOW. And I want to start with something I said the last time I covered this stock. because it's really important. I called ServiceNow the stickiest of the three. The idea was hospitals, banks, governments, massive corporations. They run their entire internal operations through ServiceNow, IT tickets, HR workflows, legal requests, procurement, all of it. And once you are embedded that deeply into how an organization actually runs day to day, you don't just swap it out. You don't cancel it over a weekend. Ripping out ServiceNow isn't a software decision, it's basically a surgery. That thesis has gotten stronger. Here's what just happened. ServiceNow reported Q1 2026 results just last week. And they didn't just beat guidance, they beat every single metric at the high end. Subscription revenue, $367 billion, up 22% year over year. Remaining performance obligations, $27.7 billion, up 25% year over year. Large deals, contracts above $5 million in net new annual contract value, grew nearly 80% year over year. 80%. And then there's Now Assist. That's their AI product suite. The number of Now Assist customers spending over $1 million per year grew over 130% year over year. And the CEO, Bill McDermott, gets on the earnings call and basically says, that $1 billion AI revenue target we set for 2026, we're blowing past it. We're tracking toward $1.5 billion, $1.5 billion in AI-specific revenue in 1 year from a product that's still scaling. And here's a detail that doesn't get talked about enough. ServiceNow's own internal AI agents now resolve 90% of employee IT cases, 99% faster than human agents. They're not just selling AI to enterprises, they're running it themselves at that scale. That's the best proof point you can give an enterprise customer who's skeptical. You don't need to take our word for it. Look at what we did with our own infrastructure. Now here's where it gets genuinely strange. After all of that, after beating every metric, after raising full-year guidance, after the CEO raising his AI revenue target by $500 million, the stock dropped 13% in after-hours trading. 13%. Why? Because adjusted earnings per share came in exactly at consensus estimates. After multiple quarters of crushing it on the bottom line, just matching the estimate felt like a disappointment to investors who've been pricing this thing for perfection. And that's kind of the ServiceNow situation summed up in one sentence. This is a phenomenal business. And because it's a phenomenal business, the expectations are so high that being excellent isn't always enough. The stock is now down over 45% from its highs in 2025. Let me give you the numbers. Subscription revenue Q1 2026, $3.67 billion, up 22%. Remaining performance obligations, $27.7 billion, growing 25%. Now Assist AI ACV target for 2026, $1.5 billion annual free cash flow. Approximately $4.5 to $5 billion price to free cash flow. Still elevated, somewhere in the 32 to 35 times range depending on the day. And I'll be honest with you here, ServiceNow is not cheap by conventional measures. A PE in the 40s, price to free cash flow above 30, those are premium numbers even after a massive sell-off. The question is whether 22% subscription revenue growth, $1.5 billion in AI revenue, and $27 billion in contracted future business justifies that premium. I run my conservative analysis, 13 to 17% revenue growth, well below what management is guiding for, free cash flow margins of 30 to 36%, a long-term multiple of 19 to 22 times earnings. At today's price after the earnings drop, my middle scenario still shows upside, but the margin of safety isn't enormous. In the high-growth scenario, the numbers get a lot more interesting. My honest take on ServiceNow, this is the hardest of the three to call right now. The business is outstanding, but you are paying for outstanding. When a stock is priced for perfection, even a great quarter gets punished. If you already own it, I wouldn't panic. But if you're looking to start a position fresh, I'd be patient. Let the market give you a better entry. It might. All right, let's bring all three together. Intuit. The AI fear got way out ahead of what's actually happening in the business. They're generating nearly $7 billion in free cash flow. Revenue is still growing double digits, and they're turning AI into a feature, not a threat. The valuation dropped from 45 times earnings down to 23. That gap deserves your attention. Salesforce. This is the biggest transformation story of the three. They went from AI is going to disrupt us to we are the AI company for the enterprise. $800 million in Agentforce ARR, $15 billion in free cash flow, a $50 billion buyback, a $72 billion pipeline. This is not a company in trouble. This is a company being treated like it's in trouble. ServiceNow, the stickiest business of the three, with the most impressive AI revenue momentum in pure growth terms. but it's still the most expensive on a relative basis. Outstanding execution, tighter margin of safety, patience is your edge here. Here's the thing I want to leave you with. These three stocks are still beaten up. The narrative is still ugly, the headlines are still bad, and historically, not always, but historically, that is exactly where interesting opportunities tend to be hiding. Not guaranteed, never guaranteed, but worth looking. Do your own research, look at the actual numbers, and don't let the fear in the headlines make your investment decisions for you. Thanks for watching, guys. I'll see you in the next one.